The current stock market dynamics differ significantly from the COVID-19 crash of early 2020, though there are some superficial similarities. Below is a detailed comparison and analysis of potential consequences. 1. Key differences between the current market and the COVID crash. A. Cause of the decline. COVID-19 crash, March 2020. Triggered by an unprecedented global economic shutdown. Extreme uncertainty about the virus's impact on health, jobs, and GDP. Liquidity crisis due to panic selling and a freeze in credit markets. Current market decline, 2024. Driven by persistent inflation, aggressive central bank tightening, Fed, ECB, and recession fears. Geopolitical risks, Ukraine war, Middle East tensions, US-China tensions. Structural issues, high debt levels, commercial real estate stress, bank fragility. B. Market conditions before the drop. 2020. Markets were near all-time highs but not in a bubble, PE ratios were elevated but not extreme. Low inflation, low interest rates, and strong corporate earnings. 2024. Markets were coming off a decade of ultra-low rates, leading to inflated asset prices. High valuations in tech, especially AI-driven stocks, and speculative assets, crypto, meme stocks. Bond market volatility due to rapid rate hikes. C. Policy response. 2020. Immediate and massive fiscal stimulus, CARES Act, PPP loans. Fed slashed rates to zero and launched unlimited QE. 2024. Central banks remain hawkish, Fed signaling higher for longer. Fiscal support is limited due to high government debt levels. 2. Potential consequences of the current decline. A. Short-term effects, next 6 to 12 months. Increased volatility. Markets may swing wildly on inflation data, Fed statements, and geopolitical events. Credit crunch risk. If banks tighten lending further, due to commercial real estate defaults or deposit outflows, SMEs could struggle. Corporate earnings slowdown. Higher borrowing costs and weaker consumer spending may hurt margins. B. Medium-term risks, 1 to 3 years. Recession probability rising. The inverted yield curve, a reliable recession indicator, suggests a downturn is likely. Unemployment could rise, leading to weaker consumption. Debt crisis in weak sectors. Commercial real estate, highly leveraged corporations, and emerging markets may face defaults. Policy dilemma for central banks. If inflation remains sticky, the Fed may hesitate to cut rates even if growth slows. C. Long-term structural shifts. End of the cheap money era. If interest rates stay elevated, asset valuations, stocks, housing, may reset lower. Deglobalization pressures. Supply chain fragmentation and trade wars could keep inflation elevated. Technological and demographic challenges. AI disruption could boost productivity but also cause job market upheaval. Aging populations in the West and China may slow growth. 3. Is this worse than 2020? 2020 was a sharp, acute shock, V-shaped recovery due to stimulus. 2024 is a slow-burning crisis, potential for prolonged stagnation. 4. Investor takeaways. Defensive positioning. Focus on cash flow positive companies, low debt, and essential sectors, utilities, healthcare. Alternative hedges. Gold, Bitcoin, if risk-off sentiment persists, and short-duration bonds. Caution in growth stocks. High PE tech stocks could face more pain if earnings disappoint. Final verdict. The current market decline is more structural and policy-driven than the COVID crash, making it potentially more prolonged and harder to resolve. While 2020 was a liquidity crisis fixed by money printing, 2024 is a stagflationary risk where central banks have fewer tools.